Hey, good morning. How's everybody? Hello.
Hello, Professor. How you doing today?
Good morning, Professor.
Yeah, hi, how are you?
We're doing
Sounds like
fine.
I have some audio issue again.
Yes.
I hear a lot of
Yeah,
static, so yeah, I might need to restart my computer at some point. But um, I people here, but I just saw two people signed into the discussion board. Um, but that's very disappointing because in the previous emails I made it, and also in uh, the posting about the class protocol, I made it very clear that the first order of business is to sign into the discussion board, right? Because that is the sign in sheet. Do the attendance first, right? Attendance report. So please, if you haven't signed into the discussion board yet, please do it now, please. That's the first thing because that is your only physical, that's your physical proof of attendance, right?
Good morning,
And I've been
Professor.
telling you, discussion, good morning, was it? The um, collaboration session is not the main lecture. If you are here without signing into the today's forum first, then there is no way to prove that you were attending. You understand? So please, sign into the discussion board, right? Thorough business. Okay. And
Sounds
since
like static
I don't know
in your
why, but
background.
it seems like yeah, there's a lot of static. There's a lot of static, and it comes from, I believe it's coming from my. So I will have to probably restart the browser. Sometimes that fixes the problem. I had this problem on last, like Thursday, so I guess I will need to restart. So I will sign off for a while because I need to restart the computer, and it will take probably 5 minutes or just to get just to reboot. So in the meantime, please make sure you are signed into today's forum. Okay, please sign into a discussion board. I will just do for my
Already am.
All right, I'm back. I hope I'm having no. Okay, no more static, right? Oh, I have
They're
static.
still static.
Ah, oh, this is so okay. I don't know why. All righty. The only other way is I just restarted the browser, but then I might have to restart the.
Check your mic. There might be something something wrong with the mic.
No, 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 no. Yeah, it could be, but there's nothing I can do with my. Let's see, my microphone. Microphone access for this device is on. Appears. Some,
If if you have a different mic, try that.
no, yeah, there's only what I see. As far as I see, there's only one mic installed in this computer. Only one microphone. Uh, all righty. Well,
Yes,
I
you
will
sound a little
reboot.
better.
Oh, now is it better now? But I hear static from your end. So, but
Let me
I
see.
can see something as
Wow.
look, no, this is not a plugin. This is not a plugin. But let me reboot the computer. Sometimes rebooting the entire computer will fix the problem. Then I'll have to reset everything. But that's fine. I can do. Um, or it could be a glitch in the collaborator. Yeah, that's true. Um, okay, let me restart the computer. So probably it will take about a couple of minutes this time. A while ago, I just restarted the browser, but then uh, completely restarting the computer might fix the problem. It will take about a couple of minutes. So uh, say I'll put you on a break for about 5 minutes. Okay, I'll be back. Okay, I'll be back. All right, I'm back. So, how is my microphone status? Does it sound better?
Better. Yeah, you
Okay,
sound better.
great. All right, I don't see any static. So let me share my screen with you. Okay, so share the screen. All right, so I'm sharing my entire screen now. So, and yeah, my mic. Okay, this is basically, the connections, connectivity or connection status. And a while ago, it was red. No, it was very low and red. So I guess that was the main reason for the that poor, audio. Uh, so I believe you have already, if you missed the collaborate session last time, uh, please, keep in mind that the live session of the day is recording of the live session of the day is always updated. It's always posted after the class every day. So did you all watch this uh, August 25th recording? If you were not in the collaborate session last time, did you watch this? Hmm? Okay, so Kenny, let's see, Kenny, did you watch that? Did you watch that recording?
You're talking about the recording from last class?
Yeah, yeah.
No,
But I
because
believe
I
you
was
were
here. I
actually.
was here. Yeah.
Oh, yeah, yeah. Jason, were you here last time? Jason, Jason Camacho, are you there? Oh, if you can, okay, if you can't speak, right? Okay. All right. So
Yeah,
yeah,
can you
you
hear me
can
now?
drop. Yeah, yeah, I can hear you. I can hear you.
Yes, I was
Okay.
here last class.
Oh, okay. All right. I just wanted to check with someone who wasn't here last time, and if they have watched that, recording of the day, because if you
I
missed this,
watched it. I watched it again.
oh, okay, good, good, good. Um, uh, okay, there you dropped it into the chat box. Okay.
I should be getting my book to within the next 2 days.
Uh, I'm sorry. What?
I should be getting my book in the next 2 days.
Oh, well. Yeah. No need to hurry. Because I'm giving you at least before the first quiz, right? It will take about actually the first two topics will be the topics for quiz one, and quiz one is on Blackboard, not on Connect. So it's not. Um, you still have time. I mean, you can get the book. Um, you can take your time getting the book, but before the first quiz. Um, so anyway, if you missed, I just want to. And I believe I sent out group email after the class last time to reminding you of that recording, right? August 25th recording. So I hope everybody has checked it out if you were not here last time. So anyway, so I'm not gonna without further ado, I'm gonna jump right into today's um, review. I'm calling this review because this is not the main lecture. Collaborate session is not the main lecture, as I said before. You were supposed to have watched the assigned videos, just like doing the reading,
first
assigned reading.
5 or 6 videos.
Yeah. Actually, as of today, I believe you have videos 4, 5, 6. Last time I gave you 1 and 2 because that was I'm sorry, 1 through 4 because that was 2-hour class and you had weekend. So if you have watched 1 through 4, you have done your assigned reading, right? That's the main lecture. And these were assigned just today. 5 and 6 were assigned just today. Okay, so think about it. Wednesdays we have 2-hour session, right? Mondays we have 1 hour session. So it's basically I assign just the right amount of videos that are fitting the time frame of that day. So this coming Wednesday, there's going to be, there will be coming Wednesdays. That's going to be September 8th, and there will be 2 videos that's going to be assigned. And then you might wonder what's after. These are like 1-hour videos, so they are 2 hours. And then it's the next time we meet will be something's not right here with the oh okay, then that will be September 13th, right? Those things. And these are not videos, they are just they may not be visible right now, but I'm gonna make them I'm gonna turn them on. Those are just links. I'm gonna turn them on later on. Now, so now let's think about with what I talked about in the main lecture. First of all, I talked about the return on investment. That's the first topic, and return on investment is basically the rate of return. When we say return, it must be expressed in percentage, right? Because sometimes people people say express return in dollars, right? Return in dollars. For example, if you bought a stock that was $100 and you sold it and it went up and went up to 150, so you sold it. So basically, you made a gain of $50. So then you might say, I made return of $50. That's just a spoken language, right? And you can make that you can say that, but actually you made a gain of $50, and when you say return, then it should be expressed in percentage. So you should say I made a return of 50%, and that's exactly 50% because you made $50 gain. That's and that's, to be more specific, it's capital gains, right? You made $50 capital gains on $100 initial investment, right? So return on investment is basically rate of return, and that's why you are in finance. That's why you invest in something, because you want to maximize your return. But in maximizing return, at the same time, you want to minimize the risk, right? Because you can get maximum return, but if you have to take maximum risk as well, of course, then it's not very efficient, right? Of course, there's a saying that you have to take a high risk, right? Where there is, a high risk, the higher the risk, the higher the return. Of course, that's usually the case, to realize, a very high return, then you should be willing to take high risk. But again, if it is unnecessary, if you have a better option, think about it. You have two investment opportunities, okay? Two investment opportunities or two investment instruments. Let's say stock X and stock Y, right? And if both of them, stock X and stock Y, both of them have the same return, right? But they have different risks. Stock X has, twice as much risk as stock Y. What's a better option? Both stock X and Y have the same return, but X has twice as much risk as Y. Then what would you choose?
The one with the less risk. Why?
Yes, of course. The one with the lower risk, right? That goes without saying. And who said that? Who said that?
That's Jason Camacho.
Okay,
I said it.
Jason. All right. Jason, all righty. You got 0.25 for that answer. You got zero. You just earned 0.25 extra point. But this wasn't a very challenging question, so I wouldn't expect a very great. It would be just an average answer, right? I'm not saying you didn't, your answer wasn't
It
great.
would have been average.
The answer would,
It's a no-brainer,
what you would expect, right? Mhm.
Yes.
Most everybody would probably come up with the same answer, right? So, yeah. Or let's put it the other way. If you have X and Y, two stocks, and they both have the same risk, if they both have the same risk, right, then which one? And X has twice the return of Y. Then what would you go for?
X.
Obviously, yeah.
X. Yeah, you would go for X. I heard somebody seems to have. Yeah, because if the
Give that
risk is
point
the
to the
same,
next.
then let me quickly check.
I had already answered, so give that to the person that answered before.
Yeah, whoever gave me the first. Okay, so who gave me that first answer? I thought it was someone in the chat box, but there was no answer in the chat box. So who was the first person to give that answer?
I think Jason Camacho answered your first question, and then me, Kenny Lowe, answered the second one.
Oh, all right. Thank you. So, and who clarified that?
That was also
Who
Kenny Lowe.
clarified?
That's me.
Kenny Lowe.
Yep.
Okay, Kenny. All righty, Kenny. I will give you also some credit, 0.25 for that clarification. Thank you. All right. Yeah, obviously, think about it. It's also a clear, criteria, because in economics there are only two ways to maximize your profit. Only two ways. One, you can maximize your revenue while holding the cost constant, right? If you can hold the cost constant and maximize your sale, right? then your profit will be maximized, because profit is basically revenue minus cost. On the other hand, if you cannot maximize sale, then what you can do is minimize your cost, right? And then, because profit is the revenue minus cost, then either way, your profit is maximized given those constraints, right? Under those, conditions. So, same concept, same idea. It's the same idea. If you can minimize, if you can hold the risk constant, of course you cannot control the risk, but at least you can compare, right? While selecting your investment instruments, while selecting your stocks, you can basically try to select the ones. First of all, you will select the stocks based on the returns, right? Based on the past returns. Of course, you'll have to take the average of them. You'll have to take average of the past returns, and based on that, you prioritize the stocks. X, Y, Z. Let's say you select. You researched. The best performers in 5 different industries, or 10 different industries, best performers in the 10 different industries, and then you rank them up in terms of these average returns, and then let's say you have certain they will be all different, right? But then let's say they have and then you calculate their risk, and also you rank them up. And then, of course, it cannot come out ideally like, they all have the same risk and different returns. I mean, that kind of scenario was only for our thought experiment, but obviously they will all have different returns and different risks, right? But the same idea applies. You will go for the best mileage. You will have to go for the best mileage, right? In other words, what is your mileage? How do you get your gas mileage? You divide the if the cars, you fill up the tank, you fill up the gas, right, in your car, and fill it up to the full, and drive until you run out of gas. And when you ran out of gas, and how many miles out have you got? If you got 600 miles, and the size of the tank is 20 gallons, then you divide simply miles driven by the gallons, and then you get 30 miles per gallon, or 45 miles. You don't get 45 miles, but let's say 25 miles per gallon. Basically, you can get this type of ratio, right? You can get this type of ratio. So the idea is, ideally, if you can select the stocks with the same risk, then it's easy. The one that has the highest return is the best. Or if you can select the stocks with the same returns but with different risks, then the one with the lowest risk is the best. But in reality, since you cannot select the stocks like with the same risks, there's and or with the same returns, it's not possible. I mean, you may be able to do that, but there's no point in doing that, because regardless of how their returns are or how their risks are, you can always take the mileage. You can always calculate the mileage. You can calculate the ratio, and the higher the ratio, the better it is. That means it's more fuel efficient, just like more, better fuel economy is always the better, right? Better fuel economy is always better. Isn't that right? Is there anyone who disagrees with that idea? Huh? You don't, huh? Anyone? I don't think there is anyone who wouldn't like the good gas mileage, right? There's no one who wants to deliberately go against uh, gas mileage, right? Or fuel economy. So, keeping that in mind, I don't know. You can't hear anything, Michelle? Uh, okay. Someone says, um, yeah. Check your speaker volume, right? Check. You see, look at the bottom here, right? Look at the bottom of your screen. You see here what my cursor is pointing at that, right? And if you, right, check that out, okay? I hope you have, resolved your problem. All righty. So let's, without further ado, in the lecture video, I talked about holding period return, and by now, if you have watched those lecture videos, it must be clear to you. Now, P sub t plus n, holding period return is P sub t plus n minus P sub t plus sum of all the cash flows between time 0 and, actually this should be a t, wherever the t is, t through n, divided by P sub t. So something you have to, was someone saying something? Now,
No,
P
I'm
sub,
sorry. I must have pressed the
what?
button by accident.
Okay. What is P sub t? Well, P stands for price, of course, price of an asset, right? Price of an asset. So, it can be anything. It can be stock, it can be bond, it can be, even real estate. So, uh, T is the time subscript. Time subscript, meaning it can be any, it can refer to any time, but um, in for our model, it would be the time. It is the time when you purchased that asset. Okay, so let's say not. So usually, time t is now, the current time, and n is the number of periods, right? So if you are talking about, if P sub t is, if t is this year, and let's say end of this year, price as of end of this year, right? N will be number of years, right? And if n is 10, that means 10 years. So then if t plus n will be 10 years later from this year, right? So then this is the price of that asset 10 years later. And since today is the end of the year, to this year, end of this year, t plus n is end of 10 years later. Okay, so obviously there will be capital gains or capital loss. Of course, most likely, if you made a good investment, there will be capital gains. Over 10 years, if the stock has been, it's possible, until year 9, the asset has been, growing. The asset price has been growing, but for some unfortunate, event, unfortunate event specific to that company or specific or general to overall economy, to the let's say the economy somehow crashed. But then if that's the case, if it is an event, a disaster, economic disaster affecting the entire economy, then there's no single company that can escape that adverse effect of the economic that disastrous event. But anyway, if no matter what the reason is, if PT plus N is lower than PT, then that's capital loss, right? Makes sense. And these would be the cash flows during those 10 years, over those 10-year period, right? Sum of all those cash flows, right? So in case of stock, it would be dividend, right? The cash flow, additional cash flows, incidental cash flows, over 10-year period. So that is what's called holding period return. Because if you were holding that asset for 10 years, that's called, holding period. Holding period can be, 1 year, or even, it can be any amount of time. It doesn't have to be yearly. It can be, 5 months. It can be 3 months. It can be even 10 days. It can be, even 5 days, right? For day traders, right? For short term, right? Day traders, they're not really investing. They're just, speculating, right? They're just, short-term speculating. So for, day traders, holding period can be, even during the day, they can buy and sell many times, multiple times. They can buy and sell the same stock, even, the same stock multiple times, right? For them, the holding period can be even, 10 minutes or 15 minutes or not, it could be the whole day or 30 minutes. But the idea is, of course, if you're holding it for a very short period of time, there can be no dividends, because dividends are paid quarterly. To get any dividend, you should hold, at least for more than a quarter, right? To get any dividend. Or dividend is not an imperative. A dividend is not an obligation, right? Dividend is not an obligation. There are many companies that don't pay any dividends. It's not a big deal, actually, whether they pay dividend or not. It's not a big deal, because if dividend is not paid, you get it all back when you sell, right? You get it all back from the appreciated price. So you get it all back as capital gains. Well, it's really, dividend is, irrelevant from, individual investors' perspective. So anyway, so usually, since holding period can vary between, investors. When we say investors, it doesn't necessarily mean only individuals. There are institutional investors and individual investors, and actually in the financial market, the portion of the in other words, in terms of capital, in terms of capital invested, right? It's called a position. In terms of dollar amount of their, institutional investors, their positions are much greater than individual investors' positions, right? So anyway, either way, because every investor's holding period is different, and when you have different holding period, it's not going to be easy to compare um, whose investment or whose holdings perform better, right? Um, so then why? Because when you have different time frame, right, it's not directly comparable, right? Obviously, if you have held it longer, you must have, uh, over 10-year period, right? Return your return ROI over 10-year holding period would be greater than your return over just 1 year holding period, right? That's obvious. Sometimes for some by some pure fluke, even if you held it for just a few months, then you may have, just like in case of Tesla early last year, Tesla was only trading at around $400, and suddenly just over a couple of months it went up to 800, which is an already 100% return, and then went up to almost like $1,600. It was just nothing but bubble at the time. They just investors just pumped it up uh, for profit taking. They knew it wasn't. Tesla wasn't, intrinsic value of Tesla wasn't 1,600, but they pumped it up to that point, and nobody knew it would go up to 1,600. It reached somewhere around that, if I remember correctly, and then they dumped it. Right? That's pure. That's pure speculation. It's um, uh, but nobody knew what was the right timing to sell. I mean, 1,600. Well, nobody knew it would be sustained. First of all, as the price went, the Tesla was probably about or even like late 2019, it was around 200, and even that was still not rational price. That wasn't fair value even at 200. But then doubled to 400 in a matter of months, and then doubled to 800 in a matter of months, and doubled to 1,600 in a matter of months. So basically, it was all because of deliberate pumping up of price, right? So it was, anything above its intrinsic value is all bubble, but investors didn't care whether it was bubble or not, because all they wanted was just to maximize their, pumped up return. So even in a matter of, think about it, if they bought it at 200 and it was 1,600 and they sold it, right? That's already 700% return, because their capital gains was 1,400. So based compared to their initial investment of 200, then this is 700% return, isn't it right? Right? So even if you hold it for 10 years, sometimes when you hold a stock for 10 years, it doesn't guarantee uh, uh, a better return than just holding it for 6 months. But that was an exceptional example. That doesn't happen. That doesn't happen every day. It doesn't happen. That was abnormal, right? And uh, it was almost like market manipulation, right? But in general, you don't 10-year holding period return is greater than, clearly 1-year holding period return, right? So then you cannot directly compare them. So what do? You have to annualize them. If all the returns are annualized, then it's easy to compare, right? Who did better? Which one did better? So I believe our time is up, right? I believe our time is up. I was hoping to get into a house value example today, but I think we will have to come back to this Wednesday. So all right. So I
It was just
will
a
have.
simple fact that we had a small glitch in collaborate.
Yeah, yeah. I apologize, but
No, it's not your fault. It's not really your
sometimes
fault.
it's also the RAM of the computer, right?
Are you running a
Sometimes
lot of Windows in the background?
no, it's just I just have one web browser open and just Excel file and PDF files. So sometimes there's a lot of junk piled up when you have
Yeah, especially in your
the
virtual
browser
memory.
open for a long time, right? If the browser has been open
Right.
for, so then you might, or the background apps, you might need to restart the computer to free up some RAM. Alrighty, so I will have to
Oh,
stop here, and so take care, everyone. I will have to stop recording uh,
thank you
and
very much,
sign out.
Professor, for your
All
effort.
right, you're welcome. All righty, take care, and I will see you guys on Wednesday.
Thank you,
Okay,
All
Professor.
this
right, guys, take it
recording,
easy.
all
Professor,
righty, this will be also updated after, today after the class. Yeah,
Professor,
someone,
today is my first day of class. This class it's only online, or we need to go to the campus?
this is only online. At the end of the semester, there is only one session at the end of the semester. There's only one session scheduled for
Which is on the 20th of December.
yeah, but obviously by then you are already done. There will be and the exam. Technically, they just planned it like that to make it a hybrid. But by then you're already done. It will be irrelevant. Okay. All righty.
Okay.
So I'll see
Professor,
you guys next Wednesday. All right.
Professor,
All
is there
right.
Thank you,
any
Professor.
assignments?
What?
Is there any assignments that we have to do
No,
for
no, no,
next class?
not yet. Not just yet. Not yet. So you will be automatically prompted. You will be automatically notified. There will be an email going out, automatically notifying you. There will be a time, a good time frame for you to. You'll be given, sufficient window to do. All righty. So I will have to sign out. Take
Professor,
everyone.
about the book, the BNCC store they don't have. I ordered and I go to receive the book in 7 days.
Okay, so you ordered through the bookstore, right?
No, no, no. I ordered in the app in the link.
Oh, yeah, okay. Either way, yeah, yeah. It might take 7 days or
But
a
then,
little, but make sure you have their, make sure you have the tracking information.
yes.
Okay, request the tracking information. Okay.
Okay, Professor.
May
Thank you.
Um,
I'm
all
for the
right,
people
the class
still
is
here?
over. But yeah. Who was that? Natalie. Natalie.
Yes, sir. I went to Barnes and Noble and this was a really great selection of just really basic math books just for anybody else interested. It was just a great section of help.
Oh, so you went to the campus bookstore? They are Barnes and Noble.
Sir, just Barnes and Nobles.
No. You wouldn't know if you go to a regular Barnes and Nobles. They don't know what they may or may not carry what they use for um, Math 056.
Well, I
So
just want to
for
catch up. Yeah, I just got some basic algebraic geometry equation type
oh,
stuff.
okay,
See you.
but
Dr.
I believe I told you to check with the math department. about
But I got
what book they use, and if you have that information, and if you ask them if they have that book, and if they do, that's fine, that's perfect.
yeah, I'll share
Okay.
it with the WhatsApp group. I'm sure we'll start a WhatsApp group soon.
Alrighty,
Just
alrighty, alrighty. Thank you. Alrighty. I'll have to sign out. Take care, everyone, and I'll see you on Wednesday. Okay.
everybody.
Bye.